Welcome back to We Are Cosmic, everyone. I'm so glad you're here today because we're diving into something that could really shape the future of cryptocurrency in the United States. If you've been following the news closely, you know that Congress is once again moving on CBDCs or central bank digital currencies. And this time, the developments could create huge opportunities for Ripple, XRP, RLUSD, and the broader crypto ecosystem. So grab your coffee, buckle up, and let's break this down together in simple terms so you know exactly what's happening and why it matters. Before we get started, don't forget to hit that like button and subscribe if you want to stay ahead in crypto news and insights. You'll want to stick around because the next few years could be critical for anyone invested in digital assets. Here's the big news. A fresh provision has appeared in what's called the Banking GOP 21st Century Road to Housing Act. This provision specifically bans the Federal Reserve from issuing a retail CBDC directly or indirectly to U.S. consumers through intermediaries, at least until December 31st, 2030. Essentially, the Fed can't just roll out a digital dollar to the public during this critical window. Why does this matter? Well, private stablecoins like RLUSD suddenly get a much bigger opportunity to grow and gain adoption because the most direct competitor, the Fed itself, is temporarily out of the game. RLUSD is a regulated enterprise-grade stablecoin backed one-to-one by dollars and treasuries under OCC-regulated trust oversight and BNY Mellon custody. This structure makes it extremely attractive in a world where Congress appears to favor private sector solutions over a government-run digital dollar. Now, let's talk about Ripple and XRP. While this CBDC ban doesn't directly involve XRP, it could still be very positive for the Ripple ecosystem. Here's why. RLUSD running on the XRP ledger could deepen liquidity, improve on-ramps and off-ramps for transactions, and strengthen the network effect of Ripple's platform. However, it's also important to understand that a lot of value could flow into the stablecoin rails themselves, not directly into XRP, unless the token is specifically integrated into the transaction pathways. In other words, this is bullish for the overall infrastructure and adoption, but investors should keep an eye on exactly how XRP fits into that emerging ecosystem. The past few years have shown us that Congress often quietly adds these kinds of provisions into larger bills. Sometimes they fade away, sometimes they stay. The key takeaway here is that even the possibility of this ban passing can shift strategy, adoption, and the focus of banks, fintechs, and payment providers toward regulated stablecoins. And that's exactly what we're starting to see. Regulated stablecoins are gaining more attention as lawmakers appear to push back against a Fed-controlled digital wallet system. For crypto enthusiasts, this is the type of news that can change the landscape and create a multi-year adoption window where compliant tokens get real traction. Speaking of traction, let's not forget market sentiment. XRP ETFs have been seeing activity with $25, $59 million traded on March the 2nd. March is shaping up to be an interesting month. Prices are stabilizing after some volatility, and the broader market has been showing signs of strength. Macro risks like global oil issues or logistics challenges still exist, but overall the tone is shifting toward cautious optimism. This is exactly why keeping a multi-year perspective is so important. Crypto has historically been volatile in the short term, but those who take a long-term view are often the ones who see significant gains. Finally, before we move deeper into today's analysis, I want to highlight why now is such an exciting time. Crypto adoption isn't just about speculation anymore. It's about infrastructure, real-world applications, and large institutions finally stepping in. Companies like MoneyGram, BlackRock, and Pantera Capital are actively preparing to integrate crypto and blockchain into everyday finance. Whether it's tokenized ETFs, faster cross-chain transactions, or enterprise-grade stablecoins, the foundation is being laid for a new era in finance, and we are at the very start of it. Now that we've covered the CBDC ban and why it could favor Ripple, XRP, and RLUSD, let's shift our focus to the broader market and adoption trends, because this is where things start to get really exciting. One of the things I always emphasize as a crypto analyst is the importance of seeing the bigger picture. We're not just talking about short-term price moves. We're talking about a multi-year trend of adoption, infrastructure development, and regulatory clarity that could completely reshape how finance works. Right now, crypto is trading at levels that are historically very cheap. According to Dan Moorhead from Pantera Capital, crypto is trading about 50% below its long-term trend and is sitting near the 7th percentile of its 8-year valuation range. Historically, 93% of the time it has been above this level. In other words, relative to its historical value, crypto is extremely undervalued. To put that in perspective, compare it with top AI companies. These companies are trading roughly 20% above their long-term trend, while crypto is trading at a significant discount. This isn't a signal that crypto is failing or unimportant. Rather, it's a huge opportunity for long-term investors. It's exactly the type of scenario where patience and a multi-year view can pay off. Crypto has always been volatile in the short term, but historically, anyone holding Bitcoin for 4 years has made money. This consistency over time is unique compared to almost any other asset class, and it reinforces why long-term perspective is critical. Short-term volatility should not scare you. It's part of the game. But those who understand adoption trends and technological evolution stand to benefit most. Adoption is happening on multiple fronts. Institutions, payment providers, and fintech companies are all preparing to leverage blockchain technology. Take MoneyGram, for example. Their focus is on using blockchain to solve real-world problems in payments and remittances. Customers want speed, efficiency, safety, and lower costs. Blockchain allows companies like MoneyGram to meet these expectations while providing transparency and accountability that legacy systems can't offer. Without crypto and blockchain, businesses like MoneyGram would struggle to survive in the coming years. This is a concrete example of how the technology is moving from a nice-to-have to a necessity for traditional finance. Meanwhile, infrastructure is improving at an incredible pace. A few years ago, cross-chain transactions could take up to 15 minutes, meaning moving tokens across networks was slow and cumbersome. Today, thanks to technological advances, cross-chain settlement can happen in just 12 seconds, with a goal of reaching near-instant 1-second transactions. Stablecoins like USDT can move across multiple networks seamlessly, reducing friction for users and businesses alike. This kind of optimization is critical for scaling crypto into mainstream finance. Faster, cheaper, and more efficient transactions create a stronger foundation for adoption, and every improvement here increases the likelihood that crypto becomes an integral part of the financial system rather than a niche market. Institutional adoption is also picking up rapidly. BlackRock, one of the world's largest asset managers, plans to tokenize all of its ETFs within the next 3 to 12 months. This isn't a speculative project. For an institution of that size, a 3 to 12-month timeline is essentially a commitment that it will happen. BlackRock manages trillions of dollars in assets, and tokenizing its ETFs could bring significant capital into on-chain finance, opening the door for trillions more in institutional investment over the next few years. The implications for Ripple and other blockchain networks are huge, as tokenized assets increase demand for fast, secure, and scalable networks. The psychology of the market is also worth noting. Crypto sellers are largely exhausted. Most discretionary selling has already occurred, and those who remain will generally sell only if they need cash urgently. Historically, this phase of exhaustion has been an excellent entry point for long-term investors. Just like in equities during the 2008-2009 period, when retail exited and fear dominated, the smartest investors stepped in to buy, leading to strong recoveries later. Market cycles in crypto follow similar patterns, and understanding this psychology can give you an edge. Now that we've covered the undervaluation of crypto and increasing adoption, let's focus on stablecoins and why they are becoming a central piece of the crypto ecosystem. Stablecoins like RLUSD are designed to combine the benefits of blockchain technology with the stability of the US dollar. Unlike highly volatile cryptocurrencies, they are fully backed by reserves, dollars, treasuries, or other assets, ensuring their value remains stable. What makes RLUSD particularly interesting is that it's positioned as an enterprise-grade, bank-supervised stablecoin. This means it operates under strict regulatory oversight, with custody provided by institutions like BNY Mellon and trust oversight under OCC regulations. In simple terms, it's designed to be a safe, compliant, and scalable digital dollar for businesses and institutions. The timing for RLUSD couldn't be better. With Congress considering a ban on Fed-issued retail CBDCs until at least 2030, private stablecoins suddenly have a major advantage. During this window, the most direct competitor, the government-backed retail digital dollar, cannot enter the market. That opens the door for private, compliant stablecoins to capture adoption from banks, fintechs, and payment providers who need on-chain dollars for transactions, settlements, and liquidity. Essentially, private stablecoins are becoming the bridge between traditional finance and the emerging digital economy. Analysts are even framing RLUSD as a potential synthetic CBDC. What does that mean? It means the coin is fully backed, operates on private rails, but can integrate seamlessly with central bank payment systems. It's like having the best of both worlds: the reliability of traditional banking with the efficiency of blockchain technology. This is precisely why regulated stablecoins are attracting attention from both the financial industry and policymakers. Congress and regulators are showing more support for private sector solutions, signaling that compliant stablecoins may become the standard for enterprise and consumer finance. Ripple fits into this ecosystem in an interesting way. While RLUSD and similar stablecoins can operate independently, integrating them on the XRP ledger provides network liquidity, faster settlements, and broader access. For example, stablecoins running on XRP can improve on and off ramps, enabling faster payments, better cross-border transactions, and easier integration for banks and fintechs. It's not just about XRP's price, it's about building a robust financial infrastructure where digital dollars, tokens, and blockchain technology work together to replace outdated, slow, and costly legacy systems. This is also important when thinking about market psychology. Many retail investors often focus only on speculative price movements of tokens like XRP. However, understanding the underlying utility, regulatory support, and adoption of compliant stablecoins provides a clearer picture of long-term value. These stablecoins are not just nice to have financial tools, they are becoming essential for enterprises and institutions who need digital liquidity that is safe, regulated, and efficient. As adoption increases, so does the demand for secure networks, and platforms like Ripple, Stellar, and others benefit indirectly from this growth. Another factor to consider is how these developments tie into cross-chain technology. As more stablecoins operate across multiple networks, the need for seamless, fast, and cost-efficient transactions becomes critical. Imagine sending a payment from one network to another in seconds instead of minutes, with minimal fees and no friction. This kind of efficiency is exactly what makes private stablecoins attractive for both businesses and regulators. They provide a practical, scalable solution for real-world financial problems, from remittances to corporate settlements. Finally, the key takeaway is that the future of digital dollars is not just about speculation or hype, it's about creating a compliant, scalable, and efficient system for global finance. Private stablecoins like RLUSD, supported by regulation and integrated with blockchain infrastructure, are poised to lead this transition. The current political and regulatory landscape, including potential CBDC bans and growing support for private stablecoins, provides a multi-year window of opportunity for adoption. Investors who understand this bigger picture will be better positioned to take advantage of the shift, whether through Ripple's network, RLUSD, or other compliant financial tools. Now that we've covered adoption trends and market valuation, let's focus on something that could really reshape the crypto landscape: stablecoins, regulation, and the role of private sector digital dollars like RLUSD. This is where the story of Ripple, XRP, and other blockchain networks intersects with real-world finance in a meaningful way. If you're wondering why the recent CBDC discussions in Congress matter, the answer lies in the critical adoption window created for regulated stablecoins. With the Federal Reserve barred from issuing a retail CBDC until at least 2030, private solutions now have the stage to gain trust, adoption, and infrastructure support from banks, fintechs, and payment providers. RLUSD is particularly well positioned to take advantage of this environment. It's designed as an enterprise-grade stablecoin, fully backed one-to-one by US dollars and treasury holdings. It operates under OCC-regulated trust bank oversight, with BNY Mellon custody for extra security. Essentially, RLUSD is a private, compliant alternative to a government-issued digital dollar. Analysts have even framed it as a synthetic CBDC, meaning it mimics many features of a central bank digital currency, but remains privately issued and fully reserve-backed. For banks and enterprises, this makes it attractive because they get the benefits of a digital dollar without having to wait for the Fed to roll out its retail CBDC. For Ripple and XRP, this creates some indirect but very important benefits. A stable-compliant dollar on the XRP ledger can deepen liquidity across payment rails and improve on- and off-ramp flows, making Ripple's ecosystem more robust and functional. That said, investors should note that value may flow primarily into the stablecoin rails unless XRP is strategically integrated into transaction pathways. In other words, while RLUSD can benefit from this regulatory environment, XRP's growth will depend on how it fits into the larger infrastructure. Nonetheless, the emergence of regulated stablecoins signals a shift in the market, where compliance, efficiency, and integration with traditional financial systems are becoming central to adoption. Why is regulatory clarity so critical? Simply put, traditional institutions won't commit billions or trillions of dollars to crypto networks without clear rules. We've seen that companies like MoneyGram, Broadridge, and BlackRock are actively preparing to integrate blockchain into their operations, but they need guidance from regulators like the SEC, OCC, and other authorities. When regulators signal that innovation is welcome and there are safe paths for compliance, it opens the door for large-scale institutional investment. This is where private stablecoins really shine. They provide a bridge between the traditional financial system and decentralized infrastructure, while remaining fully compliant with existing rules. It's also worth noting how these developments change the narrative around CBDCs versus private stablecoins. For years, some in the crypto community were concerned that a government-issued digital dollar could dominate adoption and make private solutions irrelevant. Now, with the Fed restricted from retail issuance until 2030, private stablecoins have a multi-year window to establish themselves as the standard. Banks and fintechs will naturally gravitate towards solutions that are ready to integrate with central bank payment rails while remaining compliant. This is exactly the niche RLUSD is targeting. We're also seeing concrete moves toward adoption beyond theoretical discussions. Payments companies, remittance services, and financial institutions are increasingly using blockchain-based solutions to improve speed, reduce costs, and increase transparency. The success of RLUSD and other compliant stablecoins depends not just on speculation or investor hype, but on solving real-world problems. Companies like MoneyGram are using blockchain to make payments faster and more secure, while tokenized assets allow firms to streamline operations that would otherwise be slow, expensive, and opaque. Stablecoins play a central role in this ecosystem because they act as the medium of exchange, the bridge between traditional finance and blockchain infrastructure. Now that we've explored stablecoins and regulatory support, let's talk about the real-world adoption of blockchain technology by institutions, because this is where things start to become tangible. We're no longer just talking about hype or speculation. Large financial firms are actively preparing to integrate crypto and tokenized assets into their operations. Take BlackRock, for example. They manage trillions of dollars in assets globally, and recently their CFO confirmed plans to tokenize all of BlackRock's ETFs within the next 3 to 12 months. For a company of this scale, that timeline isn't hypothetical. It's effectively a commitment. Tokenized ETFs mean that billions, potentially trillions of dollars could move on chain in the very near future, fundamentally changing how investment products are bought, sold, and settled. This is huge for networks like Ripple, XRP, Solana, and others that provide the infrastructure for these transactions. Tokenization doesn't stop at ETFs. Companies like BitGo are building infrastructure for tokenized equities and other on-chain assets. This is no longer a future concept, it's happening now. The shift toward tokenized assets allows institutions to improve efficiency, reduce costs, and offer more transparency for investors. It also positions blockchain networks as the backbone of next-generation financial systems. What's critical here is that regulation is keeping pace. Unlike in previous years when innovation was stifled by uncertainty, regulators like the SEC are now signaling that they want innovation to happen, but in a way that is safe for investors. This regulatory clarity gives companies the confidence to invest billions of dollars into blockchain infrastructure without fear of being shut down. Cross-chain technology is another major development driving adoption. A few years ago, moving assets between networks could take up to 15 minutes, making cross-chain transactions slow and impractical for real-world use. Today, thanks to technological advancements, cross-chain settlement can happen in as little as 12 seconds, with goals of reducing it to 1 second in the near future. This kind of speed and efficiency is crucial for stablecoins, tokenized assets, and institutional payments. Imagine paying a merchant using a stablecoin on one network while the merchant receives settlement on another network, all happening instantly in the background. The technology is removing friction and creating a seamless experience that traditional banking simply cannot match. Institutional adoption isn't just about speed, it's about scale. Companies like MoneyGram are integrating blockchain and stablecoins to improve payments across borders, saving time, effort, and cost for their customers. Traditional banking rails are slow, expensive, and opaque, which creates inefficiencies that blockchain can solve. When institutions adopt these systems, it's not just a small improvement, it can fundamentally change the flow of capital, reduce settlement risks, and create a more connected financial system. Stablecoins become the medium for these transactions, while networks like Ripple provide the infrastructure to handle them efficiently. Another important point is market psychology during this institutional adoption phase. Crypto sellers are largely exhausted. Most retail investors who wanted to sell have already done so, meaning there's less downward pressure on prices from speculative selling. This creates an environment where long-term institutional investment can have an outsized impact. Historically, periods of seller exhaustion combined with innovation adoption have been excellent entry points for investors who maintain a multi-year perspective. This reinforces the idea that crypto is maturing from a purely speculative asset class to a functional financial system. Finally, it's worth noting how all these elements, tokenized assets, cross-chain efficiency, regulated stablecoins, and institutional adoption, work together to create a multi-trillion-dollar opportunity. When major firms like BlackRock, Broadridge, and MoneyGram invest in blockchain infrastructure, it's not just about their own operations. It signals to the rest of the market that crypto is ready for mainstream adoption. We are now entering a phase where blockchain technology, stablecoins, and digital assets are poised to support trillions of dollars in global finance, providing both opportunities for investors and the tools for financial institutions to operate more efficiently. Now that we've covered institutional adoption and infrastructure, it's time to talk about something just as important: market psychology and investor behavior. Understanding these elements is crucial for anyone serious about crypto because the emotions driving the market often dictate short-term price movements, but they can also reveal opportunities for long-term investors. Right now, we're in a phase that many analysts describe as market exhaustion. Essentially, most discretionary sellers, those who would sell out of greed or short-term fear, have already exited. What remains are those who may need funds for personal reasons like emergencies or life events, but overall, selling pressure is low. This is historically a powerful setup for long-term accumulation because the market has already priced in much of the fear and uncertainty. To understand why this matters, let's look back at history. In the financial markets during periods of extreme fear, such as late 2008 and early 2009, retail investors exited equities en masse. Headlines were negative, sentiment was extremely pessimistic, yet those who maintained a long-term view and invested during the exhaustion phase saw significant gains in the years that followed. Crypto behaves in a similar way. After large drawdowns, sentiment turns fearful, retail exits, and only informed long-term investors remain. These are precisely the conditions that often precede strong uptrends, especially when combined with technological adoption and institutional participation. Another factor amplifying this opportunity is the relative undervaluation of crypto compared to other sectors. As we discussed earlier, crypto is trading 50% below its long-term trend and near its 7th percentile over an 8-year range. Meanwhile, sectors like AI are trading above their long-term trends. What this means is that from a relative value perspective, crypto is historically cheap, creating a multi-year opportunity for investors willing to take a long-term approach. In other words, the combination of market exhaustion, low valuations, and increasing institutional adoption creates a scenario that rarely appears in financial markets: a chance to accumulate digital assets at historically discounted levels before the next wave of adoption drives prices higher. Market psychology also explains why short-term volatility shouldn't scare investors. Many people get caught up in day-to-day price swings and news headlines, but these are often distractions from the bigger picture. Crypto has a long history of volatility, yet Bitcoin and many other major assets have consistently rewarded holders over multi-year horizons. Understanding that volatility is part of the growth process allows investors to focus on adoption trends, regulatory developments, and infrastructure growth, factors that have a much greater impact on long-term value than daily price noise. Exhaustion isn't just about selling pressure, it also reflects the broader market dynamic. During these phases, innovation is quietly moving forward. Companies are building infrastructure, integrating stablecoins, tokenizing assets, and preparing for mainstream adoption. While the media may focus on fear or negativity, the reality is that the underlying systems are improving and institutions are quietly entering the market. This is the perfect time for long-term investors to position themselves for the next phase of growth because they are buying into an ecosystem that is structurally stronger than before, with regulation, technology, and adoption all moving in their favor. It's also worth considering the broader implications of regulatory clarity. When lawmakers, regulators, and institutions align to create safe pathways for innovation, it dramatically reduces risk for long-term investors. We're talking about trillions of dollars sitting on the sidelines waiting for clear rules before entering crypto markets. Once regulatory certainty is achieved, this capital can flow in rapidly, creating massive growth potential for compliant stablecoins, tokenized assets, and networks like Ripple that provide the infrastructure for these transactions. Market exhaustion, in this context, isn't a sign of weakness. It's a precursor to a wave of adoption and institutional participation that could drive significant value creation. Let's focus on the final piece of the puzzle: cross-chain technology, infrastructure optimization, and what all of this means for the future of crypto and your investment strategy. 2 years ago, moving assets across different blockchain networks was a slow, costly, and complicated process. A cross-chain transaction could take as long as 15 minutes, creating friction for merchants, users, and institutions. Today, thanks to rapid technological innovation, cross-chain settlement is down to roughly 12 seconds, with the ultimate goal of reaching 1 second finality. This kind of speed makes real-world use of crypto practical, whether for stablecoin payments, tokenized equities, or large institutional transfers. Imagine sending a payment in USDT on Tron and having it instantly settle on Polygon, all without worrying about which chain is involved. That's the future we're moving toward, and it's extremely bullish for networks like Ripple, XRP, Solana, and any blockchain capable of handling high-speed, multi-chain transactions efficiently. This is not just about technology for technology's sake. Fast, secure, and efficient networks enable adoption at a scale that was impossible just a few years ago. Enterprises like MoneyGram, BlackRock, and Broadridge are actively preparing to leverage this technology to tokenize assets, settle transactions faster, and reduce operational costs. For example, BlackRock's plan to tokenize all of its ETFs could bring trillions of dollars on-chain, creating demand for reliable blockchain infrastructure. Similarly, tokenized assets for equities and other financial products reduce friction, improve transparency, and allow institutions to participate in digital finance in ways they couldn't before. Networks that support these transactions will naturally become more valuable, not only for investors, but for the broader financial ecosystem.